And let's turn back now to the major indexes. I'm joined by Thomas Hayes, chair at Great Hill Capital. Tom, thank you so much for coming on the show.
Thanks for
good to
me.
see you in person, finally.
Likewise.
Again.
Yes, it's been a while. Great to be here.
Amid the pandemic, it's wonderful to have you. So a decent day for stocks.
Yeah, no question.
What do you make of the market action?
Well, I think, Kristen, no one is positioned for any good news, and you're seeing a little bit of a chase up. If we look back to the Bank of America Global Fund Manager Survey just about a week ago, we saw managers have the highest cash levels still since the pandemic lows, since the great financial crisis lows, since the tech wreck lows. So any bit of good news is going to drive this market higher, and that's what we're seeing today.
So, and I think what you're trying to tell me is that there is still a lot of money on the sidelines, right? Money that does, at some point, need to be put to work.
No question about it. And people are worried about inflation. There's no question about it. But when you look back throughout history, even in 1982, which was the worst inflation bout, the S&P dropped only 27%. We dropped 25% peak to trough. In October of 1982, Volcker came out while inflation was still close to 7%, and he said, we may change tactics. And that's all he needed to say. Within 4 months, the market recovered all of its losses.
Wow.
Within a year, it was 20% above its all-time high. So I'm not saying that's going to happen necessarily today, but we do have the favorability of seasonality post-midterm elections. So on average, market's up 18% the 12 months after the election. And November through May is the best time to be in stocks.
Well, let's go back to the Fed, because I think some people are expecting that, right? As soon as the stock market does start to turn, I think a lot of potential retirees are hoping that this stock market really does rip. Can Fed policy impact the stock market in that way?
Yeah, it has impacted the stock market, and they've been talking down the stock market. Although we did have Mary Daly from San Francisco yesterday. She came out and she said that the financial conditions are so tight right now, it's as if the Fed funds rate is at 6%. She's a break from the consensus, which means they may be getting ready to dial things back in a sense in December, going 50 basis points versus 75. We've had 4 emergency hikes, as you know. That's some serious tightening. So 50, maybe 25, and then maybe pause. If the market starts to sniff that out, people are not positioned for that, and you're going to see days like this over and over, and Santa may come to town.
Santa may come, like for the Santa Claus rally, right?
You bet.
Okay, well, that would be a positive.
Yeah.
Last 5 trading days of this year, first 2 trading days of next year. Santa Claus rally good for more than a 1% gain on the S&P.
Yeah, that's right. And also you see some seasonality in December as well. You know, I like Warren Buffett. He says, if you wait for the robins to sing, it's already spring. Everyone's looking for these earnings revisions to come down, okay? Earnings revisions for next year have come down about 8% in the last 5 months, and you have analysts out there saying they're going to come down another 10%, another 20%. But if you look at the last 5 periods, the stock market bottoms 6 to 12 months ahead of the trough in earnings. So if you do believe earnings are going to come down 10 to 20%, that's not a reason to stay out. Historically, that's a reason to start to add in the highest quality stocks.
And I think that's something that investors should remember too, right? I mean, typically the stock market is 6 to 9 months ahead of kind of where Main Street usually is, right?
You got it exactly. It's a discounting mechanism. So everyone looking for the recession, they're looking forward at the gloom that's going to happen, but they're not looking back at the 25% peak to trough correction we had in the S&P already, the 33 some odd percent correction in the NASDAQ. So I think it's the time to start to ease into the highest quality stocks that are on sale, and there's a lot of them out there.
Okay, what are some of the highest quality stocks that people should be biting at for maybe some of these Black Friday deals?
Well, you know, I follow Warren Buffett. I think it's really interesting. While most managers were sucking their thumbs, waiting for China to invade Taiwan, Warren Buffett went in with $4 billion and he bought Taiwan Semiconductor. That's trading at 13.5 times forward earnings. It has a 5-year earnings growth rate of 21.5% moving forward. They have a moat around their business. You look at Amazon. Amazon's been cut in half. Why? They overspent on warehouses during COVID. They thought they extrapolated that forward, that was going to happen forever. They're cutting those costs back. Amazon's going to be fine. We saw Disney with Bob Iger. That's another stock down 55%. They've got a huge moat. If you look 3 to 4 years out, are more people going to go to the parks or less people? More subscribers on Disney Plus. The subscribers grew. The parks grew 36% in the most recent quarter, year on year. The problem was the spend on Disney Plus, and they took care of that by getting rid of Bob Chapek and bringing back in Bob Iger, and he's going to bring some great creativity.
So how do we make sense of the Disney stock price move, though? Because it was initially up with a nice pop on the surprise Iger news, but then I do see it is down today.
Yeah, well, it's the knee-jerk reaction. Then the next step is, what's the plan? What are you going to do for the $27 million that they're giving you over the next few years? And I think Bob will certainly be out in the next couple of weeks with that plan, and I think the market will be very comfortable moving forward. He has the relationships, he's going to invest in creative content, and he's going to cut the costs at Disney Plus to make it worthwhile.
So let's talk about the dreaded R word, recession.
Yeah.
Does your forecast imply a recession, Tom, on the horizon?
Well, I'll tell you, we may have already had it, and it hasn't been declared yet. First 2 quarters of this year, negative GDP growth,
right.
as you know. The third quarter, one-off exports, we also had a negative 0.6%, even though the headline number was plus 2.7. Those were one-off energy products, so we may have already had 3 consecutive quarters. What would happen to the market if next week NIBR came out and said, oh, by the way, we did have a recession in the first half of this year, and people are in all this cash, highest cash level since the great financial crisis,
right.
The market would take off. And that's not to say that won't happen, but even if we do have a recession moving forward, I think a lot of that may already be discounted into stock prices of high-quality companies, and there's opportunity here.
So going back to some of these retail results that we've been getting, and we'll have Nordstrom here on the docket momentarily, double-digit pops. Now, is that just a case that so much bad news was baked in?
Yeah, I mean, the pessimism level is so palpable right now, and the consumer is really strong. They still got a ton of savings left over. The average homeowner has $207,000 of equity. That's across the entire country. They've got record savings still. I know you're seeing the credit card spending move up, but the consumer is still in good shape. And that's why our base case is a softer landing, maybe a below trend growth for next year, but not necessarily a recession. And even if we have it, a lot of it's certainly priced in with great stocks.
So look into your crystal ball, Tom, okay?
Got to dust it off.
Dust it off. When does the stock market finally turn around? When can we see a bottom?
Yeah, I mean, it's unclear. He who picks bottom gets stinky finger. However, we may have already seen it. I mean, we had the bottom in June. We had the retest in October, and we actually went below that. I wouldn't be wholesale buying the indices. I would be buying the highest quality blue chip companies that have been cut in half on sale, like the Disneys, like the Amazons, maybe the Taiwan Semiconductor if you're a little risky. Now that the dollar's coming down, international stocks are going to start to come back in play in the next 12 months. So there are opportunities. There are a lot of things to do out there.
Okay, we'll have to have you back on the show to talk about this international stocks because still so many questions, right, about Europe.
Yeah, no question.
Amid this invasion, but perhaps some deals to be had. So Thomas Hayes, chair at Great Hill Capital. Thomas, thank you.
Thanks for having me, Kristen.
All right, and come